So this is the last chapter of our course. Congratulations on getting this far. And we're going to talk about the statement of cash flows here. So there are two ways of preparing the statement of cash flows, the direct method and indirect method. I will only focus on the indirect method, and that's what you will be tested on. So this is the purpose of the statement of cash flows. Cash is such an important account that it deserves its own financial statement. It's really the only account that has its own financial statement. So we're looking at the cash increases and decreases, and these are some of the questions that the statement of cash flows help us answer. So this is a definition of cash, and when we're talking about cash, we actually mean both cash and cash equivalents, and I'm defining what the cash equivalents are right here. They're short-term, highly liquid investments which are readily convertible into cash, and usually the company will convert them into cash in fewer than 90 days. So let's distinguish between three types of cash activities: O, operating; I, investing; and F, financing. Simply speaking, I want to mention that investing activities would mostly include our buying or selling long-term assets for cash. It's kind of misleading because when we talk about investing, we sometimes think about stock. In this regard, we mean investing in our long-term assets. So if we are buying equipment or buying a piece of land or selling that piece of land or a truck or a car, that would be an example for cash. That would be an example of investing activities. Only cash related. So if we're purchasing a piece of land on a note, that would not go here. Only if it affects cash. So investing activities mostly are concerning long-term assets, buying or selling for cash. Financing activities concern any cash transactions that deal with stockholders' equity and long-term liabilities. So borrowing money on long-term, or paying the amount of principal back, or issuing stock for cash, or paying cash dividends will go here. And everything else is operating activities. Another way to think about operating activities, this would be actually the total of operating activities will be our cash net income, versus the amount of net income that we report on the income statement is actually the accrual net income, right? The accrual net income does not care about cash. It includes revenues that have been earned but have not been yet received, and it includes all expenses that have been incurred without any regard to cash. Remember that? But for the operating activities, this will be our cash net income, our true cash inflows minus cash outflows. So the actual classifications could get a little bit more complicated, as I said. So operating activities, like I said, any cash flows that determine net income. So like I said, anything for day-to-day activities, anything that impacts our current assets and current liabilities, right? So if, for example, I am, I'm earning revenue, cash revenue, or I'm paying off for my accounts payable, or I'm paying off to buy supplies, or I'm paying for, day-to-day expenses. The exceptions are notes receivable. It's a current asset if it's a short-term asset, and it actually will be classified as an investing activity. So if we, for example, lend money on a short-term note, that's a note receivable, that will go into our investing activities. And notes payable, anytime we borrow money short-term or long-term, that will actually be classified as the financing activity. Now, investing activities, as I said, mostly anything to do with long-term assets, but also short-term investments and notes receivable. By the way, when we earn interest on note receivable, or when we pay interest on note payable, both of those, interest revenue and interest expenses, will actually be classified as operating activities because they go to the income statement. And so again, investing activities, mostly they impact long-term assets as well as any kind of short-term investments, and notes receivable. And financing activities, anything to do with long-term liabilities, equity, as well as the notes payable, but not the interest expense. So let's go to this quick study and look at some of the examples and classify them. So quick study 12.12-1, page 504. So 12-1, page 504. Let me actually go right here and let's do it together. Okay, so we sold long-term investments for cash. That would be an example of an investing activity. Sold long-term investments that we held for cash. It's an investing activity, and I would say plus, right? It's a cash inflow. Cash is coming in. I received cash payments from customers. That's an example of O, operating activity plus cash coming in. I paid cash for wages and salaries. That's also operating, right? That would be an example of a wages and salaries expense which goes on the income statement. And that would be cash outflow, cash minus. Number 4, I purchased inventories for cash. That is an operating activity. It impacts the current asset inventory. And I'm going to say it's going to be cash minus, cash outflow. Paid cash dividends is classified as a financing activity, F, and it would be cash minus outflow. Issued common stock for cash, cash is coming in, cash inflow, and it's an F, financing activity. Received cash interest on a note, interest would be classified as an operating activity, and it would be a plus. Paid cash interest, that's also an O, but now we're paying cash, so that would be cash minus, cash outflow. Received cash from the sale of land at a loss. We'll talk about losses a little bit later, but we received cash, right? So cash goes up, ignore this word loss. We are selling a piece of land, we're receiving cash, it's an investing activity, plus because we are receiving cash since land is a long-term asset. And we paid cash for property taxes on building. That's a day-to-day operating activity, cash minus. Okay, so that's the classification. You have this table in your textbook, which kind of again shows to you what goes, how do we classify our cash flows into 3 categories. Now, there are some non-cash investing and financing activities, and these are examples, right? We retire debt by issuing equity stock. Like instead of paying back on a bond, we convert them into shares of stock. Right, so we give our bondholders shares of stock and there's no cash exchange. Or we convert preferred stock to common stock. Or we lease assets in a capital lease. Or we purchase long-term assets on a note or a bond. We borrow money. It's like buying a car and getting a loan from a bank without a down payment. Or we exchange non-cash assets for other non-cash assets, right? We exchange one truck for another truck or a piece of equipment for inventory. Or we purchase non-cash assets by issuing equity or debt. So these are not a part of the statement of cash flows, and we report them on the bottom of the statement or in the notes. So let's prepare the statement of cash flows. This is an example: operating activities, net cash provided or used. If it's positive, it's provided. If it's negative, it's used. Operating, investing, and then financing. And then we have a total increase or decrease in cash. And we have a cash balance from the balance sheet of the previous period. And we add or subtract and we get cash that we already have on our balance sheet at the end of the current period. So this amount right here on the bottom is the same amount as the balance of cash on the balance sheet. So we usually will need comparative balance sheet. So I need balance sheet for 2 years. We have a current income statement and we need some additional information. And I have an illustration problem right here where we have all that information. So I have a comparative balance sheet for 2021-22, I have an income statement for 2022, and I have some additional information for 2022. So instead of going through too many slides, I want to mention here that we have, I think I already mentioned it, there is a direct and indirect method. So GAAP actually prefers direct method, and it suggests that companies should use direct method, where we directly list, cash received from customers, all cash transactions. And this direct versus indirect method only concerns the top portion, only cash flows from operating transactions. Investing and financing, there's no difference, right? It's only about operating inflows and outflows. Now, look at the bottom. Net cash would be the same answer. It doesn't matter which method you use. Even though GAAP suggests we use direct method, 99% of companies use indirect method because it's just easier and it has the same result. And so I will cover the indirect method only. The direct method is in the appendix. Okay, applying the indirect method of reporting. So again, we're just looking at the operating cash flows. These are your 3 steps. What do we begin with? We take the net income figure from the income statement. So this is our accrual net income from the income statement. And then we add non-cash expenses. A typical example is depreciation. If you think about depreciation, right, we subtracted it on the income statement to get to the net income. But depreciation has nothing to do with cash, so we have to add it back in. And then we're going to do the opposite for losses and gains, and I'll explain it separately. So if there are any losses, they actually have nothing to do with cash, so we have to add them back in. So I subtracted losses on the income statement, but because they are non-cash, I need to add them back in, and I do the opposite with gains. I added gains on the income statement, but now I have to subtract them because they have nothing to do with cash, or we would be double counting cash actually here. And then, guys, we look at any changes in non-cash current assets and current liabilities, and I'll talk about that step separately, and we get cash flows from operating activities. So get the net income figure, do steps 1, 2, and 3. So this is an excellent exhibit. I'm going to follow it. So I'm going to illustrate with the problem how we're going to follow the steps. But before I go there, I want to talk about gains and losses, right? So as I mentioned, losses have to be added back in. Gains have to be subtracted. So here is an example. So for example, we sold equipment that costs $51,000, and we had accumulated depreciation for that piece of equipment for $22,850, and we sold it for $26,050 cash. We covered it with you in chapter 8 in financial accounting. I'm sure it was a while ago. So I need to take off my books equipment and accumulated depreciation. So I'm going to offset accumulated that's a long word, accumulated depreciation for that equipment. So I want to remind you that accumulated depreciation is a contra asset minus plus. So since I'm getting rid of this equipment, I'm going to debit the accumulated depreciation account to make it 0, right? Made it 0. And guys, equipment I'm going to credit because it has a normal debit balance. So when I am going to credit it, again, I have set it, it becomes 0. Cash I am receiving, and it's 26, so we debit it. Now, we can just plug in what's missing, right? Or we can, let me actually put this one right here. What's missing, right? And I'm missing here, I'm missing here, let me calculate. So my debits together are 22,850 plus 26,050, 48,900, and my equipment is 51,000. So I'm missing 2,100. And it's a debit. So if you're missing a debit, that's a loss. That's a loss on the sale of this equipment, right? On the disposal of equipment, we will say. Loss on disposal of equipment. If I were missing a credit, that would be a gain. Or another way to think about this 2,100, Look at my book value here, right? My book value is 51,000 minus accumulated depreciation of 22,850. So it's 28,150. 28,150. But I'm getting 26,50 in cash. So I'm getting less than my book value. I'm losing 2,100. So you and I are gonna record this cash on the statement of cash flows in the investing section, right? I'm selling equipment. I'm getting $26,050 here. So I'm going to record it as a cash inflow in the investing section. So the loss that I recorded has nothing to do. I already recognize the amount of cash that I recorded. I don't need to subtract an additional 2,100 because it would skew my balance of cash. On the income statement, I had to subtract it. But for the statement of cash flows, we're going to add it back in. And for the gains, I have a different example. So we call the bond right here. Calling a bond meaning retiring it early with a par value of $100,000. So bonds payable, again, we covered it in chapter 10 in financial accounting. So I'm going to debit it to make it zero. It's a liability. And an amortized premium. So premium is an adjunct liability. It has the same signs as liabilities, minus plus. So I'm going to debit it to make it zero, right? So premium on bonds payable. Oops, premium on bonds payable is $6,000, and the cash that I receive is going to be 102,000, which includes the cash, the call option. So cash is 102, and you can see here again, I am missing now a credit, right? This is 106, this is 102. So when I miss a credit, that means we have a gain. So this is an account called gain on a bond retirement. But if you think about it, we're going to record this cash, right? We are receiving this cash, and it's going to go to the investing section because we are dealing with a long-term debt here. So I don't need, if I also added gain, that would skew my cash. I would double count. That gain is already included in this 102,000. So even though I added this gain for the income statement, I need to subtract it. So we do the opposite. Gains are subtracted for the statement of cash flows. Okay, enough about that. So let me follow these steps using the illustration example. So what we're going to do, we have this example right here. We need to take, first of all, net income. So this is my net income, $158,100. So this is the statement of cash flow, cash flows from operating activities. So the first thing we're going to do, we're going to take this net income, accrual net income. Next step, what we need to do, we need to make adjustments to reconcile net income to net cash provided by operating activities. So guys, again, let me show you back the slide. It's steps 1 and 2, right? So I have to add back in any kind of non-cash expenses and losses, such as depreciation mostly. There could be depletion amortization. It's mostly add back any depreciation, and if you have losses, add them back in. And then we're going to subtract any kind of non-cash revenues and gains. Mostly just going to be gains, if there is any, right? So let me look at what we've got. So let's do depreciation first. The business will always have depreciation. We have depreciation expense on the income statement. So I have to add it back in. Again, I subtracted it, but it's a non-cash expense. So to reconstruct cash net income, I need to add it back in. So we're going to add depreciation expense. Here we go. And guys, also there is a loss. An example I showed you about equipment is described right here. Remember, we sold equipment with accumulated depreciation, blah, 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 blah. So I actually showed you right here that we have this loss of 2,100. So I'm going to take this loss right here and add it back in. The problem actually tells you the loss on the cash sale of equipment is 2,100. So I'm going to add it back in. Here we go. So these are additions. These are steps 1 and 2. We're done with it. There are no gains. There is no gains, no non-cash revenues. And then step 3, I have not spoken much about it. Look what we're going to do here. And just don't get confused. We'll look at changes in current assets. We're comparing balance sheets for 2 years. Any increases in cash assets, we need to subtract. So if, for example, account receivables went up, that difference has to be subtracted. So we do the opposite. If it went down, we need to add it back in. So if we have more accounts receivables, that means we collected less cash, right? So an increase in current assets. If we have more supplies, if we have more prepaid expenses, any increases in current non-cash current assets, any increases, we do the opposite, we subtract them. Any decreases, let's say my inventory went up. I'm sorry, my inventory went down. What does it mean? That I sold it and I got more cash. So again, if the inventory amount is decreased, we add it back in. So for current assets, we do the opposite. If it goes down, we add it. If it went up, we subtract it. For current liabilities, we do the same in correlation. If the current liabilities went up, if accounts payable went up, we didn't pay accounts payable, we have more cash. We add it back in. If the accounts payable current liabilities went down, that means we paid it off. So I have to subtract it. So for current liabilities, you do the same what happened with that current liability. You do not touch notes payable and notes receivables though, because they're not part of the operating flows, cash flows. Okay, so let's look right here. I'm going to just look at these babies right here. Non-cash, here they are. Non-cash, non-cash, right? Non-cash. And we'll look at them. What happened with accounts receivable? Went down. If it went down, cash needs to go up. If it went down, it means I've collected more. So we're gonna, inventory went down, so we add it back up. Prepaid expenses went down, so we're gonna add it up. So when current assets go down, we add them back up. And here's the information, right? So decrease in accounts receivable, decrease in inventory, decrease in prepaid expenses. We're gonna add all of them back up, add them back to the cash flows from operating activities. Now, for current liabilities, I am only going to look at accounts payable. Remember, notes payable are not here, right? So here we go, accounts payable, what happened to them? They went down. When they went down, it means I paid them off. So that decrease needs to be decreased, right? So decrease in accounts payable is going to be decreased. Oops. Here we go. Oops. It's a decrease. So overall, right? Net cash, so we take net income, we add all of these amounts and then subtract this 84,250. So net cash is positive, so we say provided by operating activities 130,200. What does it mean? It's my cash profit. This was my accrual, that was my accrual net income, this is my cash profit. This is really the only complicated part of this chapter, right? Now we have 2 more sections left, and it's the cash flows from investing and financing activities. I'm not going to go through these slides. Instead, let me just finish completing this illustration problem, right? So cash flows from investing activities. So we'll look at, usually you will be given additional information. So did we buy or sell any long-term assets? We sold this equipment, remember? And we sold it for 26,050 cash, so that would be cash positive. And we purchased equipment. It doesn't matter what the cost is, it matters how much cash we paid, because the rest of it we signed a long-term note payable, so that's a non-cash purchase. So we have with you cash received from the sales of equipment, and we also have with you positive inflow and cash paid for equipment. So overall, we have a negative net cash used in investing activities, but it actually looks good. You know, I have cash provided by my operations. I have plenty of cash. So my spending some cash here means that I'm investing in the future of the business. And for financing activities, right here, we're borrowing $5,000 cash. So we got cash in and we signed a short-term note payable. By the way, it's also right here. You see this? My short-term note payable went up by 5,000. And my long-term note payable also went up, and they give us information. We also went down, sorry. So we paid all 47,500 cash to reduce the long-term note payable. We also paid some cash dividends right here. So that's cash out flow. And we issued shares of common stock. So we're going to take 3,000 shares, multiply 15 by $15. So we're going to get $45,000 cash inflow. So the financing activities include anything to do with borrowing and with equity. So borrowed cash on a short-term note, paid off cash negative on a long-term note, received cash from issuing stock positive, paid cash dividends, overall net cash used negative in financing activities. So net increase in cash. I take my positive operating, negative investing, and negative financing, and I can see that overall I have an increase in cash. Then we take cash of 61,550, which is from the previous year. Net cash balance. And we're gonna add my net increase in cash, and my bottom line is my cash balance for the current period, which is 123,450. Let's double check. It should be equal to the balance of cash on the balance sheet, and it is. This pretty much, guys, concludes our my lecture for chapter 12. Thank you for your attention.